Hello, everyone. Welcome to today's webinar, the Retirement 101 Know Your Options webinar. I am Jenny Taylor, and we have a couple other hosts with us today. We've got Ben Russell, as well as Denny and David. So we have those guys joining us today. We're excited to have you all here. I just want to do a little bit of housekeeping before we get started. We do a lot of Zoom webinars and meetings, so you're probably well aware, but let's go over it anyways. If you guys have questions, there's a Q&A box. That's where we'd love for you to put those questions so that we can answer those. Sometimes we may answer those live, but a lot of time we'll answer those behind the scenes. But also, if you just have comments or we might ask you a question, have a response, send that to us in the chat, just so, because sometimes questions can get lost in the chat there. Also, if you'd let us know where you're joining us from today, that would be great. We've got quite a few people on here, and we just like to see, where you guys are joining us from. So welcome, and we're excited to get started. So let's first go over, well, what can we expect from today's webinar? Why are there so many different types of retirement accounts, and what are they, and what may we need? There's a lot of different options, and what would maybe be the best, for you where you're at right now in your either career, life, savings, all of that. And then one of the main things that we're going to touch on is how are your retirement savings going to be classified by the IRS? So we'll talk a little bit about that as well. So what are the different options, that are out there? And for some of us, you may actually have an employer that has a sponsored retirement account. This could be anything from a 401k to a 403b. There's things called thrift savings plans. There's also pension plans. And inside of that, there's a lot of different other names that you maybe have heard of as well. Then for those that maybe are self-employed or want to save some extra, there's what are called individual retirement accounts, or just IRAs. We've got traditionals, Roth IRAs. You could inherit IRAs from other people. There's also SEP IRAs, which we'll talk a little bit about as well as something called a simple IRA. So the most important decision, really comes down to, is this going to be a pre-tax or post-tax kind of contribution, and what impact is that going to have on me in the future? So the question that you'd kind of pose there is, do I want a tax deduction today and then have to pay taxes when I withdraw later? Or do I want to pay taxes today and then withdraw tax-free in the future? So that's one of the kind of the overarching questions to be thinking about, when it comes to the type of retirement account you'd be looking to open and maintain. So first of all, we're going to spend some time talking about the employer-sponsored retirement accounts. So if you work for a company that offers a retirement package, there's not much choice you have in what kind of option you can choose and select. It's going to be what they're offering and whether you want to participate in it or not. Sometimes you don't have, you don't have to. Sometimes it is just going to be part of the package that they're offering you as an employee. Again, this could be a pension plan, a 401k, 403b, many different things listed there. But in this example, we're going to be talking about a 401k, which would be considered a defined contribution plan versus what would be a defined benefit plan. So a defined benefit plan would be like a pension plan that pays out a certain amount each month when you retire. Or like a certain percentage of your salary. Some will pay 50%, some might pay 80% of what your, maybe top 5 highest grossing years of your salary, and they take the average of that, and then they're going to pay out X amount of that upon your retirement. So with this, a 401k type of plan, it's defining how much is being contributed into it. So you personally would make pre-tax or post-tax contributions to your retirement account with your as part of, with your paycheck. You'd say, hey, I want to put 5%. And what's neat about this is often the employer will match up to 3 to 5% of your salary. Now, if you're putting in post-tax contributions, meaning you've paid the taxes up front and you're putting that in, the employer puts in pre-taxed, meaning you're going to have to pay taxes on that, and the earnings from that when you take the distribution. So this can be where there's tax deductions for you if you put in pre-tax funds. But also it is, it is a benefit to the company that is doing this because they also get tax deductions on how much they contribute to retirement, their retirement plans for their employees up to a certain level. So right now, though, when you do contribute pre-tax funds, there is a required minimum distribution, and you have to start taking that at age 73 currently. So again, the money is growing tax deferred. The Roth may be growing tax free. And then there's a max contribution of $23,000 a year. And as we go look at the next ones, you'll see this is actually a lot higher than what you could do, with a regular traditional IRA or Roth IRA. What's really interesting, though, about the 401ks, and specifically a Roth portion of a 401k, which again, that's where you make contributions that are pre-taxed, is there's no income limit to make the contributions. You could put $23,000 in a Roth IRA every year, with an employer sponsored account like this, which is different than a personal Roth that has some income limits there. So what if your employer doesn't offer retirement benefits, or maybe you're self-employed? There's a few options. Also, sometimes people only want to put into their employer sponsored account up to what their employer is matching, and then maybe have more control over their own investments by putting more back in retirement in, say, a self-directed traditional or Roth IRA. So with a traditional IRA, you do contribute the pre-taxed money. So that could potentially reduce the tax liability for you that year by reducing your earnings for that year. There's a max contribution of $7,000. 8,000 though, if you're 50 or older, because it's kind of like catch up, you can save an extra $1,000 a year. Now these numbers, as well as on the last slide when it said the limit was 23,000, these numbers get adjusted every year. So these are the 2024 numbers, and going, each year you'll have to see what that new limit is. The funds, because you don't pay taxes before you put it in, it is tax deferred. So taxes are paid when you take the distributions out. And again, the required minimum distributions begin at age 73, but that will rise to age 75 in 2033. And do you guys know why they require you to take distributions out of the retirement accounts when they are tax deferred? Ben, you'll have to tell me if somebody knows and puts it in the chat, because I don't have that open right now.
Okay, I can do that. So let's see. So they get their tax money.
You think? Right, yeah. It really is. It's because you haven't paid taxes on it yet. They realize people could, like, maybe never take it out and send it to the next person. And after they pass, it goes to the beneficiary. And so what's interesting about that is, then if you inherit an IRA, you have to continue the required minimum distributions based on the person's age, of what they were when they passed away. So they want to collect their taxes, right? It is important that you do this, though, that you do the RMD, because if you don't, you're charged a 25% fee or tax, sorry, um, on the amount that should have been taken out, in addition to your regular federal or state taxes that you would normally pay. So let's say you didn't take out, you were supposed to take out an additional $10,000 this one year. Well, you'd be paying $2,500 in this fee, or this fine, as well as then the federal and state taxes on the whole $10,000 amount. So that's why, you do need to make sure to take that. And there are these RMD calculators online. I think you can specifically find them on like irs.gov as well. So the next one here is the Roth IRA. The interesting thing about your Roth IRA, again, is you're contributing the post-tax money, meaning you've earned the income, you've paid taxes on it. You can contribute the 7,000, 8,000 if you're older than 50 or older. But everything that would grow in that account is actually going to be tax-free. So it's tax-free upon distribution, and there are no required minimum distributions. Now, there are eligibility restrictions when it comes to income. Higher earners, it phases down, or you may not be able to contribute to this at all, which is different than the Roth 401k, which you can continue to contribute to that. So this is another option, which is interesting also to consider the tax implications of just growth of your account growing over time, growing, tax free. And the other thing about just retirement accounts that aren't the post tax, your pre tax ones, you're getting taxed at your federal state income level when you take your required minimum distributions. Um, Even if your gains came from long-term capital gains, which is, 10, 15%, again, depending on income level, but also then depending on, whatever happens with the tax code going forward. So there are some reasons to look, potentially at Roth, which we'll talk a little bit more about as well. But there's also what we call the Simplified Employee Pension, or the SEP IRA. This is a great potential for self-employed or small business owners. And you can, again, you do contribute the pre-taxed money to this one. And but you can contribute a lot more to this. It's a max of 25% of salary per employee, or 69,000 for 2024, whichever is less. So this is good for those higher income self-employed individuals. A lot of, dentists, doctors, lawyers, as well as I know people who are in construction, and they're, more of a small business owner that enjoy the SEP benefits as well. So then these are tax deferred, taxes are paid upon distribution, and then you do have the required minimum distributions. So all of these three that I just went over, the traditional, the Roth, the SEP IRA, they are self-directed accounts, but that they can't, so meaning you can manage them yourself, or you could have an advisor help you manage them. And since everybody's situation is different, you have different income levels, different earnings, different tax, benefits you're looking to gain. We just ask that you consider speaking with a tax advisor or CPA to see what they would maybe recommend to help you maximize any tax benefits that you could get from opening these types of accounts. So Danny, you're with us, and in the next section, we're going to be talking about, a little bit about the different comparisons, and how saving in these different accounts what could that look like for us in a few years?
Yeah, absolutely. So there's a couple different types of IRAs. There's a traditional IRA, which is put in with funded with pre-tax dollars. And then there's the IRA, the Roth IRA, which is post-tax dollars. And the biggest difference is you can pay tax now at probably a higher tax rate, or you can pay no taxes later. So with a Roth IRA, you have no tax from your gains or the capital that you put into a Roth IRA, whereas a traditional, you're paying the tax, you're doing it pre-tax. I'm sorry, I'm skipping all over my words. I apologize, guys. But a traditional IRA, you're paying the tax when you take the money out of your account. So depending on what your tax bracket is in your retirement, you'd want to make those decisions. Now, the nice thing is you can actually have both accounts if you'd like. But this next slide actually shows you how a return on $200 a month over 30 years with an 8% average growth, retiring at 69, and withdrawals are increasing at 5 years, will last you I think it is about 20 years. So, and if you look at the traditional, putting in $250 a month, it lasts about the same amount. So again, it really depends on what your tax bracket is. And we always encourage you to talk to your tax professionals when you're looking at these things. But the nice thing is you can actually have both.
Yes. Yep. And that is a great point. So David, do you want a quick run through this slide, or would you like me to go to the comparison one?
No, yeah, this is good. So we're going to continue on with this comparison between the Roth and the traditional IRA. As you notice with that Roth IRA, in that example, they were putting in $200 a month, right? With the traditional IRA here, we're going to now put in $250 a month. And the extra $50 is because the taxes are deferred with the traditional IRA. So we got a little more we can put in there, right? And so we're also going to be contributing for 30 years in this traditional IRA example. In this example, we're going to assume a 20% tax rate. Your situation could vary, but we had to pick a number, so we're going to choose a rough average, right? And we're going to go with the same growth rate, 8%, still retiring at 69, and withdrawals also increasing 5% per year. What we're trying to do is we're trying to keep as many variables equal to provide a better comparison study. So when you look at that, there's a few things that you'll notice here, right? First, you'll note that the initial balance is higher than the Roth IRA. See that? With the Roth IRA, it was $300,000. With the traditional IRA here, because we've been putting more in, we're at $372,000. This is about a 24% increase, right? And this is because of the increased contributions, because we have the deferred taxes. However, the amount that is withdrawn is also higher, because we have to pull more to cover those taxes when we have the traditional IRA. The Roth IRA doesn't have to do that. So, this kind of leaves you with the same take-home pay, if you will, where we still have that $24,000 to pay our bills and everything. Now, you'll notice that with both the traditional and the Roth, they both ran out at about 83, 84 years old, right? So with both routes kind of having similar ending results in this study, which one is better for you? And that's what Denny kind of alluded to this, this would really come down to taxes. Now, if you're in a lower tax bracket right now, and you expect that your tax liability may increase in the future due to increased income, maybe from trading or something like that, or just due to legislation changes that raise taxes, that that's common. If we think that we're going to be in a higher tax bracket in the future, the Roth IRA might be the better option for us. Right now, if you are in a high tax bracket now, let's say you make pretty decent money, that's great. Amen to that. You say you're in a high tax bracket and you expect that you're going to be in a lower tax bracket in the future because you have that loss of income when you retire. Maybe the traditional IRA would be the best option for you. Honestly, we're going to highly recommend that you have a conversation with your tax professional because they're going to be able to help you understand which is the best option for you when we really are making this decision around taxes. So thank you, Jenny.
Yeah. Well, and one thing I'll add to that is if you are in a higher tax bracket right now, the more you can save and invest it tax deferred into your retirement accounts, that is deductible from your gross, your gross income for that year. So it lowers your income. And sometimes if you can save enough into those different things, it might even push you down to a different, a lower tax bracket. So that is why we say, consult with your CPA tax professional about that. So thank you, David. I do want to go over one more scenario here in this little comparison part of this webinar. What if you have a 401k and your employer matches some of this? So this is where if you're contributing the $250 a month for 30 years and they match 50%, okay, that's going to equal $375 a month total. All the other assumptions are the same. This was pre-taxed in this scenario, assuming the 20% tax rate, growth rate of 8% a year, retiring at 69. Because you're saving more and they're matching 50%, this, again, in this scenario, it would last through 93 years old because of the additional matching or savings. And really, the main takeaway from all of this when it comes to saving for retirement is you got to, if you can start saving early. We might have some people in here that are in their 20s or early 30s. Start saving early and systematically to have that potential for the largest growth that's out there just from the compounding of your earnings over time. So, Ben, we've talked about some of the benefits and pros to all the different types of retirement accounts as well as the employer sponsored ones. Are there any limitations to our employer sponsored accounts that we might have?
Yeah, actually, Jenny, it's one of the things that, the name of our company is called TRADEway. It's one of the things that we really want to make sure everyone understands is the limitations that come from your employer are often pretty limiting. What do I mean by that? Well, if you've been into any of our education, you recognize that often you can find potentially higher returns by being in individual stocks or being able to do things around options, or there's lots of things you can do if you have the skill sets and the know-how. But the employer sponsored retirement programs, they're like, they
Cookie.
really clamp down on what you can do. And if any of you out there have a 401k, you've probably already experienced this. They're like, what do you want to invest in? And you go and you look and you have 12 choices. And
It's
they
cookie cutter.
dramatically limit what you can come into because they really don't want the liability. They want to put you into stuff to where they just have a very defined small box, and it actually helps them to kind of cover their liability on the backside related to these employer sponsored programs where they've done all the due diligence required and they don't have any liability associated with these specific choices. Now,
Hmm.
here's the problem. Those specific choices are almost always oriented towards a bull market. I don't know about you, Jenny, but we're going to talk about it in a little bit. I happen to know as a trader that the market isn't always in a bullish environment. And knowing that it's not always in a bullish environment, and knowing that most of my employee sponsored programs have extremely limited bearish choices, it makes me want to be able to have some opportunities to potentially shift this equation. I know how damaging a bear market can be.
Yep. Yep.
So, what are some of the ways that you might be able to help with that? Well, you can do a rollover. Now, Jenny, this is something that came up as a question. Cindy was asking this question. Hey, I've heard that you can move a portion of your traditional IRA into a Roth IRA. And as long as you don't touch it for 5 years, that's a viable option. That is absolutely true, Cindy. Let me say it in a different way. You can take a pre-taxed IRA account, and it's called a
Hmm.
conversion to a Roth. And what happens, however much you decide to convert, Uncle Sam wants his tax money today.
Yep.
Uncle Sam wants his tax money early, right? So he's like, please convert as much as you want to Roth, like right now. You're very able to do that. Now, I would suggest on that one, you definitely want to talk to your tax professionals because our income system is based on bands of income. So what a lot of people will do, Cindy, is they're getting close to the end of the year. They're looking at how much of their income do they have, how much until they get to their next tax bracket. Like, I can afford to convert $20,000 this year from my IRA to my Roth because it doesn't push me into the next tax bracket. And it's a pretty effective way to work with your advisors. You know, uh, People like TradeWay can help you with those things and your tax professional to kind of help maximize those for the longer term. And John, you are correct. If you have a retirement account in a previous employer, it is very easy to change that from the 401k to do a conversion over to a self-directed IRA where you are not limited in the choices that are available to you like you would in your self-directed or your employer-sponsored program. It's one of the major reasons why most people, when they leave their employer, are like, can I get that money out? Yes, you can. And most people do it as soon as possible to have greater control and greater opportunity to be able to have a wider investment choice on their funds. So, yeah, John, that's exactly what we're looking at. And, it's not just a previous employer. Sometimes, Jenny, this is what we find to be interesting as we're helping a lot of people. Sometimes your current employer may allow you to do
Hmm.
at conversion before you leave employment. whether the full amount or even a partial amount. I don't know about you, but as a trader, I love having greater control over those funds. Those are my nest eggs. I would like to get them out and to have much greater control over what we do with those assets. So it's partially why we're bringing this up is the 401k programs are awesome, but they are very limited.
Mhm. Yeah, they're very cookie cutter as to what you can and can't do. That's for sure.
Autofilled. Okay. Let's see. So Jenny, do you want me to answer another question here before we move on?
That's fine.
Okay, so that was Cindy's question. Thank you there. Bamik is asking about, can you roll pensions into a Roth? Typically not. Dominic. Um, the reason being is because pensions are pre-tax programs, like a pre-tax 401k or a pre-taxed IRA. Think about it. The term is pre-tax. You haven't yet paid tax on this. The only funds that can go into a Roth are funds that you've paid taxes on. So what you could typically do, Dom, you could take the funds that are in a pre-tax pension program. They could and often do offer you a lump sum pre-tax payment that you move into an IRA. And once it's in a pre-tax IRA, what could you do? Choose to start converting part of that into a Roth and paying the taxes. So yes, there's lots of opportunities there, and this can be a little complex, but it's the reason why TRADEway is financial services. This is part of what we do is with our clients, we help have consultations like this to help you to figure out the best way to manage your funds.
I think that was it for the questions right now.
Sounds good.
So we are going to transition a little bit and talk a little bit more about uh, what what can you do during a bear market, or what are some of the signs that we might be, that not might be going into one, but when there is another cycle of a bear market, what can you do? So Ben, I know we've got a few slides we want to cover for that.
Yeah. And the part that gets interesting here is we know bear markets happen. And there are risks typically to the economy that come somewhat of a precursor of when do we think a bear market may be coming. But unlike our traditional 401k programs, unlike a lot of the defined benefit programs, as a trader, I want to be able to try to get out of the way of what I know to be a very difficult to make money in cycle. When economies are contracting, that means most of the equities that we're invested in these programs, they're going to go down pretty dramatically in value. And that's when we see the really big negative returns on the market, which then impacts our 401ks, our IRAs, all of those programs. So let's talk about that a little bit. Is there any risk that we see coming? So let's go into that next slide, Jenny. The thing that really causes you and me and many of the other program managers inside of our AMPT portfolio a little bit of pause is we know that the last really major decline in 2008 was caused by the financial services sector becoming insolvent. And it was about the banks and a lot of bad debt on those banks that they were unable to continue to do business. And the reason why I'm bringing this slide up is that we start to see some of the same underpinnings happening in our current economy. With the way that the Fed has increased interest rates faster than they ever have at any time in our nation's history, the second quarter of the FDIC, they go out, they evaluate these banks, they look at the banks. Now, what's interesting is that although they're looking at the health of the banks, they're not telling us which banks they're looking at, but 63 banks in Q2 came under their list of not looking so good. All right, so in 2022, it was 39 banks were in danger. In 23, it was 52. They just said 63 back in March, and the one they just released in June, there's now 66 banks, Jenny, that the FDIC is concerned that if their names were to get out, they might have a run on their deposits. So they're not going to tell us who those banks are, but they're watching pretty close.
Yep.
So do we have any examples of some bank failures? Well, we'll talk about those in just a minute. But before we do that, Jenny, we've got a lot of people on here today, and I'd like to know, with the FDIC report showing the fragility of the banking system, we haven't mentioned David Mitchell yet, but our founder of TRADEway, he suspects that the commercial real estate market, well, after COVID, you really don't have the same commercial real estate market that we did. There's a lot more work from home. The value of those properties is really suspect, and people can't get loans on those programs for any kind of interest rate, even close to what they had during COVID. Think about it. Very, very low interest rates just a few years ago. And now it can cost upwards of 7 to 8% to get a loan. Well, the commercial real estate market's being dramatically impacted there. So the question that we want to ask, if we were to move into another 2008 style crash, if we were to move into another bank collapse, and 66 banks are now under watch, if another financial crisis were to develop, could you change your investments? Could you protect your money? And I'm curious, right? We've got a really good crew on here today. I'm wondering, just by a way of a poll question, Jenny, go ahead and launch that poll for me if you would. I'm wondering how many of you are you confident? We believe buy and holding is dangerous. Are you confident that you could make a change to your portfolios and your environment that you're creating, your nest egg for the future? Are you pretty confident that you'd be able to get out of the way of the moving train in the next financial crisis? Oh, well, it's interesting, Ginny, because this is what we see to be really consistent with most people that come to TRADEway. Our government institutions, the 401ks of the world, do not make it easy to know how to get protected. And it's one of the things that as TRADEway, we care about you, we care about your family, and we're trying to expose people to some of the alternatives that are out there so that you don't have to go through that next financial crisis with a buy and hold mentality. That's pretty
Yes.
awesome, Jenny. I mean, we've got a lot of people that answered that poll for us today. It's
Yes.
interesting to see that approximately 80% of the people on with us today, they wouldn't know how to get protectionary if they were in a crisis situation. That's why we
Yes.
do what we do.
And inside the 401ks, even if they do give you options to adjust, sometimes it's limited and you can only change your allocations once or twice or three times, but there's a set number of limit of times. So you really do need to be proactive and find out from whoever is in charge of that what your options are for uh what you can or can't do when it comes to changing your allocations.
No,
All right,
it's a great call out, Jenny. And part of, knowing the choices, the plan participant choices, where you can place those funds is a huge part of that because it's not intuitive and easy in most of these programs to even know what they're invested in. Like they give you the name of the fund, and from the name of the fund, you're supposed to know how it works. Really? Most of us can't do that. So being able to in advance know what your fund choices are and where you can go if we do find ourselves in an economic storm, it's a really important part of your long-term financial planning. In our opinion, as TRADEway advisors, we would like for you to know the answers to those questions before the potential storm hits.
yep, that's sure. I'm going to go ahead and end the poll here. So thank you
Awesome. Thanks,
everyone for
everybody.
answering that. And then I will go here. So I think some of us, I mean, I know I remember last year when Silicon Valley Bank failed, and it was a very interesting scenario. It was resolved rather quickly by the Fed. And hold on a second, the poll keeps popping up right in front of my face here. But it really was resolved quite quickly by the Fed. And for the first time in history, they actually stepped in and covered all deposits, not just the FDIC covered up to 250,000 of assets per depositor, but all of it. And the thing about this bank specifically is it was full of venture capitalists, so people with lots and lots and lots and lots of money. So probably most of the accounts were greater than $250,000 per depositor. And I guess it's great that they did this for them, but the question is if there were a bunch of bank failures, would it happen for other people, right? Not just venture capitalists, but for the more quote unquote kind of normal type of investor or bank, not banker, but person that, you know, banks at the bank. And if you do have assets over that, it's likely not going to be covered. But what specifically happened in this scenario with SVB was that they were holding a lot of long duration bonds. And if we remember, the Fed had just raised interest rates quite drastically, and bonds and interest rates they're inverse to one another. So the value of a bond will actually decrease as the interest rates go up. So these long duration bonds had lost so much face value because interest rates were so high that when SVB had people coming and saying, I want my cash, I want my cash, they had to go and sell these bonds for a huge loss. And eventually they couldn't even continue to raise enough cash to pay the people at the bank that were coming to get their money from the bank. And that's how this bank failed. And again, the Fed stepped in, you know, they did extra of their job to cover all of the deposits. But this is something that, you know, we're constantly monitoring. Ben just went over the fact there could be issues, you know, with some of the commercial real estate that we're seeing, and that could impact banks as well. So we're glad right now that they did come in and that there hasn't been a ripple effect through all of the banks. But we can also learn from the past failures that have happened and the past bear markets that have happened as well. We can learn from that and see what we could maybe do differently in the future.
Well, you know, Jenny, it's interesting to recognize the past bear markets. The one that still ripples in our economy today is what we know as the financial crisis. And in 2006 is when it began to sort of rear its ugly head. And those yields you talked about, Jenny, as far as those interest rates and how the bonds were impacted, well, it created what we call an inverted yield curve. And this is not intuitive, but an inverted yield curve is when you get paid more for a shorter duration note than what you do a long term. So in our economy, for example, we've actually seen this today. When I go to do a 10-year note, I get paid less money for a 10-year note when I get paid more money for a 2-year note. Now, if my mortgage could work that way, that'd be awesome, but it doesn't. It's not reality. The financial system does not handle that well. Our entire system is predicated on being able to borrow money today at a lower rate and then get paid more for it for more time. And when we can't do that, a lot of things start breaking in the background at the banks. And it's actually what causes a lot of the stress that the FDIC is actually tracking. The Fed created the very problem that the FDIC is attempting to expose to all of us. And it's very similar as to what happened in 2006, which led to the 2008 financial crisis. These very safe instruments, things that were backed like mortgage-backed securities, the Fannie Mae's of the world, the government institutions that were backed by property, all of a sudden weren't as safe as what people thought they were, because I don't know if you remember this time, but people were walking away from their homes. I owe more money than the home is worth. Here you go, bank, you can have it back. And now the banks had more properties than what they could shake a stick at. And unfortunately, because there was so many properties that were coming into the banking system, they were having to sell them at fire sale prices. And there weren't a lot of buyers because there weren't a lot of people that could get loans. And see, that's the other part, that point number 3. When the banks had to go sell the properties, there were a lot of people that couldn't qualify to get a loan, nor did they want to pay the interest rates on those loans. So the Fed decided to do something they've never done before. They stepped in and they avoided the destruction of the United States economy and the Western world, according to to Mr. Buffett. We were on the precipice of going over the cliff to destroy the entire Western economy. The fact that the Fed stepped in, now this is during the time of President George Bush. The economic advisors under George Bush, they decided to go in and cover all the debts. But it wasn't until there was pretty dramatic damage. This is the part that gets me. 56% decline in the market is what happened. 56%, Jenny. So let's go look at this on the next chart. Let's talk about this on the next chart, because this next chart puts these words into pictures. The bear markets through history, and on the left-hand side, what you see is the bear markets. Now, I love this slide because what it helps us to be able to do is we can actually see how those bear markets through history have functioned. What's really interesting about it, Jenny, is the gold bar up top is how long did it take to recover, right? So in that one, which one are you pointing to? What's that date? 73, right?
Yeah, that was 73. I
Okay,
just
so
went to
in
the tallest
73,
one, you
it took,
know.
I'm sorry, say it again.
I said I just went to the tallest one, 69 months.
Okay, so let's look at what this slide is saying. Dark blue bar. How long did the market move down? All right, so in 1973, it moved down 21 months. I think at some point during 21 months, not quite 2 years of downward motion in the market, as a financial advisor, I think I might have gotten a clue that I need to do something different. Well, in your 401ks, you often don't have any opportunity to do anything different for 21 months. And over that 21 months, what did it do? It went down 48%. Wow. Half your portfolio evaporated. And then what did it take to get back to even? Because this is what they always say, just buy and hold because it will come back. Okay, that's true, but how long did it take? 69 months. Ouch. I think I want some different tools. I want some different skill sets. I want some different options that maybe are not available in my traditional 401k programs because of the limitations that are in those programs. And that's not the only time it happened. All right. So Carter year 73 was a bad one. 2008, the year 2000, in 2020. I mean, we can just see every few years these things happened, and these historical declines, especially in a recession. I'm not sure if you can see it, but at the bottom, do you see how after those years, there is an R after the date? Well, those are when the economy declined. And when we go into a recession, on average, the bear markets are at least 34% down. I don't want to see a 34% decline in my portfolio. And I don't want you to see a 34% decline in your portfolio in the next bearish cycle, because there is some representation that a recession could in fact be coming, particularly after the presidential election. So there's some things we're watching as a company that make us go, it might be time to get in what we're doing. Now, David, I think this is interesting. I wanted to ask you a question here. So I'm looking at March of 2020 and October of 2027. Some people have called this the lost decade because you got your money back just to lose it again, right? So look, it took 56 months to get your money back in the year 2000 just to start the same crash in 2007. What were you doing in that time frame?
Yeah, Ben. It's kind of interesting you mentioned that because guess what? In fall of 2000, when the dot-com crash started, I was in 5th grade. And then, 2007 happened and we lost all that money again, almost a 60% decline at that point. But yet it did come back, guys. It did come back. The year was 2013 when we finally surpassed where the market was in 2000. In 2013, I had graduated from college. I'd been married and I've been married for 2 years actually. And, so that's a long time that there was no progress. Let's bring this a little closer to home. Let's say that you're 52 years old and you're gonna, for the next 13 years, not make anything more in your retirement accounts. That's pretty hard, right? You're expecting, I got 13 years to build before I'm 65 and I retire, but you don't make anything because you withstood a 50% crash and then a 60% crash. That's going to be really hard. If we take a look at this next slide here, guys, we're getting nerdy with some numbers for a second, okay? All right, so you can see here the first column there. If you're looking at a 10% drawdown on your account, in your mind, you might be thinking, okay, but if it goes up 10%, I'm back to break even. No, no, no. Look at the next column. You have to go up 11% to get to break even. You're thinking, okay, that's not too bad. You're right, it's not too bad. Let's look at the next one. 20%. You're down 20%. You need to make 25% just to get back to break even. Oof, okay, that's different. That's different. If you're down 30%, got to go up 40, almost 43%. Let's get down to 50. This is the dot-com crash, 2000. The market dropped 50%. Everyone's retirement accounts had to double to get back to break even. And guess what it did? They always say the market will always come back. Well, yeah, historically it does. And it did. And that year was 2007. And then we got to experience close to a 60% decline. And then things had to come back 150%. And yes, it did again. But like we were saying, that was a 13-year period from 2000 to 2013 that there was no progress there. So if you could avoid those drops, how different would your account look? Would you like to learn how you can avoid riding the bears all the way down? We're here to help with that.
David, that's such a great point. And it's the thesis that we at AMPT, Assisted Managed Portfolios by TRADEway. And Jenny, if you don't mind, so here you see on the screen, that's Ben, Jenny, Denny Foster, David Verbugen. We are a part of TRADEway known as AMPT, AMPT, Assisted Managed Portfolios by TRADEway. We're a full investment advisory services firm that can help you with, can we do some of those conversions? Can we do some of the rollovers? Can we manage the portfolio for you in such a way as that our primary thesis is to protect your funds during those significant downturns? David, you asked the question, I want to underscore it. Think about not going through a 50% decline, being protectionary. I like to say there's a hurricane coming. What do? You get prepared for the hurricane before the hurricane hits. We know these economic hurricanes come. So if you were prepared for the economic hurricane, you boarded up your portfolio's windows and you survived through that economic hurricane with almost no scratches. You had a little bit of damage in the yard, but your house was fine and everything came through with just very nominal damage. What's going to happen? Well, you now have the opportunity while your neighbors are trying to get back to even. David, what did you say that 60%? If we went down 60%, what do the portfolios have to go up again to get to even?
150%. Just a
Oh,
bunch.
okay. So if I didn't lose as much money and I have a 60% decline and my neighbor had a 60% decline and I didn't have a 60% decline, when it's time to get back in the market, I got a whole lot more money and my neighbor's trying to get back to even to get 150% on their reduced cost basis, and I still have almost all my cash. I think my portfolio is going to look really different. And I'm willing to give up some of the sloppy choppy that's going to happen. I mean, the market's going up right now, but I'm going to tell you it's not doing it convincingly. And there's an awful lot of things that tell us there could be an economic hurricane coming. We want to be prepared for it. Our thesis is this: avoid those huge downturns so that when you get the next swing up, the huge bullish cycle push where your neighbors are getting back to even, that is where we think you have the best opportunity. The easiest way to get ahead is with that higher cost basis when the trading and the environment is easier. That's what we do at AMPT. And if you want to know more about that, well, let's talk a little bit about one other factor. Jenny, you mentioned before, let's move on to interactive brokers. What we do is help our clients. If you decide you wanted our help, we would assist you with creating an interactive brokers account. Now, this is like a Fidelity or a Schwab. This is where you would put your money. You have your own account. You get to see everything that we do. And the primary things, there's a couple things, but one of the big ones, most people don't want to go to cash in their 401ks or their other investment programs because you don't get paid anything. They don't want you to be in cash. Interactive brokers, they're paying 4.287% when we're in cash. So when we don't know what's going on, we're very happy with a 4.287 return on our yield for the cash. The way in which they do this, it's not like those banks that we were talking about. They don't have the same risk. They're not doing those long bond durations, and they're not having that same sort of risk where we don't have to be as concerned about interactive brokers' ability to make their payroll or their deposits because they don't do it the same way. That short-term treasury is how they do it. That's the reason why they're paying those rates, because it's all based on the treasuries. And while most other brokers only pay 1% for you to be in their programs, you typically have to move that into a money market to do it. So you have to take the cash out and kind of like park it, and you can't use it until you take it out of the money market again. Not an Interactive Brokers. As part of their cash sweep program. So when we, as your advisor, sell one of your positions in your Interactive Brokers portfolio managed by our team, our AMPT team, you are instantly earning on that cash. Pretty powerful. You don't like have to take it into a money market fund, and automatically as part of a cash sweep program, and you get paid on that. Now, the other factor here that I think most people don't quite get is, especially if you're a higher net worth investor, you need to be careful with that $250,000 limit. If you're in your local bank and you got more than 250K at your local bank, just recognize the FDIC insurance program only covers the first $250,000 per depositor. What if we could do something different? Well, Interactive Brokers does. They offer what's known as an enhanced sweep program, an enhanced cash sweep program. What does that look like? In the background, once you're a part of that program, they actually make your single account look like 10 different banks. Not to you, to them. So now each of those banks has access to $250,000 of insurance. You can have up to $2.75 million of FDIC in coverage through that enhanced FDIC insurance program. And it is one of the strongest institutions, Interactive Brokers, because of the way that they do their short-term treasuries and how they handle their enhanced FDIC insurance. It's why we use them as the safest place for us to help our clients with their cash. All right, so Jenny, I think that's a pretty powerful way for us to have that conversation. So let's go ahead and talk about, so we use IBKR. Another
Yes.
reason is that it is a brokerage platform. I can go in as a TRADEway representative who's got access to help control the portfolios. And as a trader, I can get in and out of positions, and it's known as discretionary trade authority. This is a big deal, Jenny, because if you have a traditional financial advisor, they typically don't have or don't want discretionary trade authority. They're going to meet with you once every 6 months or a year, or in the cases of your 401k, probably never. And they don't make a change in your account until you sign on the dotted line saying, I agree. That's not the way our program works. You're giving us the discretion to change your allocations at any moment of our choice. And that's a powerful difference in our program. Jenny, myself, others in the program, we can click the button and instantly change the allocations. All right, so Jenny, give me a little bit more information here. What's so powerful about the AMPT program that you want to underscore for our friends?
Yeah, and you've already hit on the discretionary trade authority. And we did already hit on this, but the fact, I just want to make this clear about the earnings of when you are in cash. This rate is as high as it is right now because of where the Fed's fund rate is. So this does adjust, and like you said, it is based on the short-term treasuries, and those all adjust based on what the Fed does with interest rates. But, at other brokers, it's maybe not even, I think we're being a little gracious when we say 1%. It's probably not even that. It may be even less. And inside your 401k, like you said, it may be right around that 1%. So that just wanted to highlight that again. And because of the different cycles that happen in the market, by you giving us that discretionary trade authority, and us knowing what your risk tolerance is, it allows us to adjust your portfolios based on the different cycles. And then we are able to manage the trades and batch the transaction fees together so that it's all grouped. The fees are, and the shares are bought all in a group. The fees are then distributed across the accounts for low commissions per, share bought of a stock. It's just very, very low. TRADEway pays the professional market data fees for the people that are putting the positions through on our end. And people will bring over all sorts of accounts to us. They might bring over LLCs, or entities or trusts, like all those retirements we're talking about are just straight cash accounts, and we're paying for the market data and not you guys. So those are some of the main benefits. Just using the tools at Interactive Brokers with their trading platform, we can get in and out of. I mean, we could do 20 different stocks at one time and get them all pushed through in probably less than a minute and getting out of all of them. It's just the platform is very good for, you know, an advisor side of managing funds. So Ben, could you tell us a little bit more of the different options or different portfolios that we offer in our
Oh
AMP?
yeah, this is where it gets exciting. So for me, what we as a company have done, and if you've been to any of our trading programs, you know that we have a philosophy that says don't treat your money the same. And we often we'll call it the 80-20 concept. 80% of your money, let's conserve that with more preservation-oriented methodologies. So for us at TRADEway, we've created a program that mirrors that philosophy, and it's called AIM, Advanced Investment Management. And it leverages the biblical concepts from Ecclesiastes and from the book of Ezekiel to create a diversified portfolio that's designed for more of a longer term approach with more diversification and more safety. And our team does that for you. We are in and out of ETFs that mimic the sectors of the economy. We'll change the allocations when we're not confident of what the market's doing. We'll pull back on allocations. We'll be more in the cash, getting that current 4.287%. When we're confident in a specific sector, we'll put more money into that sector as opposed to other sectors. And it takes just a few clicks of the button for our team to invest those for you. And it's a pretty powerful way for us to do things that your 401k is not going to do. Most of the time, they're going to leverage mutual funds, which you don't even know what they are or how they're invested. With us, we're going to be in and out of those positions based on what we see happening inside the economy. Pretty powerful way for your long-term accounts to have more of a protection mindset with the primary purpose, Jenny, of being able to preserve through difficult economic times. Why? So on the other side of the storm, we got a whole lot more money to invest when it's easy and when we know, based on the past, those largest returns are possible. That's our goal. It's the AIM program in a nutshell. What do you think, Jenny? Anything you want to add there or any questions that came up?
Great. I'm not seeing any questions that have come through. I heard you mention, you know, the 80-20. So what's this 20% stuff you're talking about?
Oh, great lead in. And it's one of the things that I find to be one of our most powerful opportunities. You know, we like puns, or I like puns, right? And those of you who have met me, you know I enjoy
You like
puns. So
puns.
we called this the Ultra Portfolio. And the UP program, notice the pun there. What this is active trading with a small portion of your money. So let's say, for example, you have a net worth. What would you be able to potentially do in our program as well? What if you could take up to 20% of your net worth and more actively trade that with TradeWay's representatives pressing the buttons for you in and out of specific stock positions? If your account is over 25,000 in and out, and the potential is for us to do a lot more with larger $25,000 and up accounts, we can and have employed options trading in these larger accounts. We're doing the work. TradeWay representatives are the ones doing the work. Shorter cycles designed for more in and out, specific profit targets, specific stop losses, controlled trade sizes. All the things that we teach you at TradeWay. Well, what if your portfolio, that 20% money, that ultra portfolio, could be invested by active traders? Well, that's what ultra portfolio is all about. And it's more of that short term, let's get in and let's get out. We're going to try to make a little higher returns on a smaller portion of our money by taking a bit more risk.
It's great, Ben. Thank you for that. How do we get them to be able to meet with us?
Yeah,
If they're
another
interested in
great
signing up?
question. So here it is. We've got the capability of being able to schedule an appointment with you. And, you know, Jenny, if you could you launch that final poll for me? The poll that I want to ask is if you're interested in spending some time with myself, Jenny, our friend David, and Denny, we'd love to be able to help consult with you. Now, what that means is we answer your questions. Realize that in this world, it can be a little complicated. Every single one of you out there has a different situation, different stages of your life. What if you could meet with a financial advisor and start to develop a plan for your family? Well, that's what this is all about. We would love to be able to meet with you, see if AMPT is a good fit for your financial goals, and to be able to work with you to be able to create a plan. Now, Ginny, I recognize that, as our friends are clicking the button, one thing I want them to know is that, they registered with us with an email address. What does that mean for them? How are they going to be able to schedule a call with us once they click the button here?
Yes. So what will happen is you're actually going to receive an email and a text message from us when very soon afterwards this, and in that will actually be our calendar link so that you can schedule a time on a day that works for you based on the available times there. So you can, either book that or email back, and we can get scheduled with you to meet to discuss your particular situation.
Perfect. And one of the things that is coming up here is we have different flavors for risk tolerance, for example, which does help to affect the results. So one of the things that's going to happen in this consult is we're going to discuss what is your risk tolerance. And we've got some really nice ways of laying out how we measure risk. And it comes down to one primary factor. The higher your risk level, the more of your funds we as your portfolio managers will put at risk in the market when we see that the market is more clearly healthy. When we're not completely healthy in the market, you're going to see that we'll even pull back and we'll kind of favor a little bit more cash with some of the positions. But we actively move in and out based on the risk tolerance that we help you to determine together. What are the fees and how is it that, that's a great question, Rosalinda. What I will tell you is that our fees are based on the amount of money you bring into the program. When you schedule a consultation with our advisor, we will go over that in depth with you. And we'll show you that unlike the IRS, we actually charge you less when you bring more money in, right? I like to call it the anti-IRS. The IRS charges you more money when you have more money. Well, not at TRADEway. We think that if you're bringing more money into the program, we should be reducing your fees. So that's the way that our fee structure is scheduled. When you have more funds in our program, you and all of your family members get that reduced fee for your accounts.
Great. And I think we've gotten most of the questions answered here.
For
And
the UP and the AMA program, we have a $10,000 minimum. Now, Rosalinda, if that is not something that you can do, you can speak with one of our advisors. We do have something that's known as a seed program, and we can have that conversation with you if you can't meet the $10,000 minimum.
that's a good question. And we did hit on, what kind of accounts we can help manage everything. So
See here, the website that you can visit is tradeway.com/amp. Someone's saying that's password protected. Let me pull that up real quick. Let me make sure. It came right up for me. So tradeway.com/amp is the name of the program. That's the website that you can go to. And it does have a lot more information on there as far as, what our fees are, how the program works, etc. Perfect. So the attendee that would like to meet with someone, simply click on the button saying that you would like to schedule an appointment. I want an appointment, but I'm not working with a specific advisor, for example. That's the question down near at the bottom.
Yep. And
Okay.
let's just say this, if you're watching this with the recording afterwards, it's not live, please feel free to email amped@tradeway.com, but you'll also have probably received this from a specific advisor, and our our calendar link will actually probably be in the email that you receive. So if you do want to meet with us after you've reviewed this, for those that didn't make it live, please just refer to that email that you'll get from one of us and book a meeting with us from there.
Awesome. Well, Jenny, this has been a really fun program. I mean, we covered a lot of information, but I also know our friends are going to have a lot more questions. So I'm looking forward to the time to be able to meet with several of them. Jenny, I know you and David, are you guys looking forward to being able to meet with our clients?
Oh,
Oh,
yes.
absolutely.
It's always a pleasure to meet with you guys.
You know, the
So,
thing that I find to be most it's interesting to see. These conversations, they lead to friendships. They lead to us getting involved in your lives and understanding your goals and the things that drive your train. And I can't tell you how many times I've talked with someone where I learn about a brand new ministry that they're a part of supporting, and it's so much fun to have these conversations. So, you know, we're all looking forward to being able to have those conversations with you to get to know you and your family and your goals better. It's going to be a lot of opportunities for us to have conversations about things that matter, not just the money. What are we looking to do with the money? That's what makes us at TradeWay excited. So we're looking forward to being able to share those visions and dreams with you all.
well, thank you, Ben, and thank you everyone for joining us today. I'm going to go ahead and end this poll here. And just be on the lookout for an email and a text message from us if you had specifically answered that poll. And again, thank you for joining us. We look forward to the next time, and I hope you guys have a wonderful day.